God bless everybody today. It is October 3rd of 2023. There is a lot going on in the markets. The markets are really struggling right now on so many levels, and the main reason is the dollar is moving up. And when that happens, commodities are going to tank. Global currencies like the emerging markets, Japanese yen, all these currencies, the lira, different things like that are losing value, and you're going to see a massive selling of treasuries, which are going to come back to us, and that's going to hyperinflate us. But as this dollar moves up against the currencies, it is destroying markets, literally destroying markets, and the Fed has been lying to you for some time about this non-technical recession that we've been in for over a year and a half, and you're getting ready to enter another one as you go into the third and fourth quarter of this year. And you watch the job numbers come out to where they're still tight and more job openings are occurring, which is causing the problem for the Fed, and that's why they're probably going to keep raising even though they paused this time in September. The next raise would be at the end of October, around the 1st of November, so we need to watch that timestamp. And you have a government shutdown that's been averted till like November 17th, so you got about a 45-day gap on that to watch and see whether they can continue to keep kicking that can down the road or they're actually going to do something. So this is going to be a pretty short video. I'm just going to run through some charts real quick so you can see just exactly how this is happening, and I believe I can do this in just a very short period of time and show you where the destruction is really occurring. So right now, talking about this for a while, and yes, it takes time to play these things out. It's not an overnight sensation. Usually it takes months to play out. Some of these indicators that I'm explaining to you, I know you want instantaneous gratification, but that's not the way this works. I originally thought we had a head and shoulders down here, and then they manipulated it, imagine that, and we ended up with a new head and shoulders pattern on the top, which I said is coming. It's just going to be a matter of time because it's a Wyckoff pattern that will happen, and we'll see a spring here before long because we're walking in the third leg of the down cycle. So here's your first shoulder, that's your left shoulder, you got a head here, and now you're starting to walk into the last shoulder. Once this shoulder forms, it will drop approximately the gap of the top to the neckline, okay, which is about $6,000 to $7,000 at this point. So I keep saying you're going to watch Bitcoin dump under 20 before long. You know, a couple weeks. I can't give you an exact date. I could probably chart it out and give you close to the day, but it keeps moving out. I keep saying this. It expands out as they manipulate things. But it does play out over time because they can't change the chart. The chart moves through. Look, charts don't change. That's why you go to the charts, because the charts will tell you what's coming. Not this feel-good sensation that they're telling you out here. The charts will literally tell you what's coming up. Okay, so let's look at some more charts and see why this is happening. So like I say, you have this massive pump on the dollar. Look at that. We had destruction back here. This is just in one day. It has settled down. It's moving back up. It's affecting all the markets. The dollar is controlling everything right now. It's affecting bonds and everything right now. So let's look at some of those numbers. So we've had a fairly severe dump in metals. Here we can go into the monthly chart. You can see that we've lost over almost 11% in the monthly chart, and that's great. If you're looking to buy silver, you're in a trench right now. It's moving down. Watch the dollar. If the dollar's still moving up, it's going to keep going down. If the dollar starts to retrace, then you'll see a pop in metals. It's that simple. It's really that simple. I say Jay's following that 2-year bond. As the 2-year bond is moving up, it is causing the Fed lots of havoc. Now, I've talked about this technical indicator for a long time. When Japanese yen hits 150, they start curve controlling, they start doing intervention, and they start selling off treasuries and stuff to prop up their economy. But they can only do this so long, and they've been doing it for so long anyway, and their GDP to debt ratio is like 300 or 400% to it's insane in Japan. And they have an aging economy, and they're looking towards services because they manufacture nothing, and their growth is stagnant, and it's just not going to happen. So the Japanese yen is extremely important because when you hit some of these levels, you know it's going to force the market to react, okay? And it is. It's ugly out here today. So as of right now, we have moved below 33,000 on the Dow. This is a significant drop. We've dropped 434 points today because the bonds are melting up. Okay, the bonds control everything out here. They're 3, 4 times the size of the stock market. Jay's following the 2-year bond. This is terrible news for him. And we got a month before he can raise again. Okay, and he's going to probably raise. He's going to have to. And they're talking about this right now. But look at this. In the last month, we've lost $1,642 dollars on on this chart, on this 34,8,000 chart, wherever it was when it was up here. Let's see, 34,641. You've dropped a tremendous amount. In the last day, you've dropped 683, and then today you've dropped 434. And so, look at these numbers. This market is struggling. And look at that. We're walking into a massive trench. People don't quite get this. Look at the daily drop. It's insane, okay? Now let's go look at the bonds real quick. So you look at the 2-year bond, you look at the 10-year bond, because the banks borrow at the 2-year rate, they loan at the 10-year rate, so that controls your mortgages, autos, and all that. It's that simple. Commercial, homes, everything, okay? Banks have you in a trap when you borrow money from them. So this is where the trap is. You were at 0% interest. Now you're at 5.142 on the 2-year, which means, guess what? You're paying a whole lot more for your stuff, okay? So you need to get out of debt if you aren't. Look at that melt up, okay? This is what they're finding. That's a year chart, okay? Look at the daily chart. Look at that melt up. Look at that. That's a huge parabolic spike. It's massive. The Fed is fighting this as they just got numbers in that said that there was more openings this month than there was last month, and they're not losing that many jobs. And you're going to see those job numbers come out in the next few days on like Thursday or Friday. So, okay, usually Thursday, I believe. So watch that. Watch this. These are massive moves. People just don't get what I'm talking about on this bonds. They control everything. It's so important that you understand what is happening. And as these melt up, it's a massive negative for the banking system, because this 2-year, now the problem is the 10-year's melting up faster than the 2-year, and this is causing a real problem because the inversion's not quite as extreme, but it's all moving up together, and it's moving up so rapidly they can't control it. So if you go to the 10-year, wow, look at that. I'm sorry, these are historic moves. I've been looking at this stuff for over 40 years. I've never seen quite like this stuff. I mean, you're going to have to go back into the Depressionary era, 1928, or we just did a lot of articles. We just saw all these articles come out that the bond rates are down around the 2007 rate, when we had the crash or recession in 2008, and this is a much stronger process than it was back then. And so when you see these massive upticks in the 10, this is causing real problems on the 30-year rate and different things like that, and I'll show you that chart now. Now, last time I showed you this chart, we were at like 8.11, something like that. Now you're at 8.4. This is causing huge increases on these variable rates, especially the 7. The 7-year balloon predatory loan that they've got you all into the regional banks because they won't offer you actual real loans anymore is going to destroy you as these loans start to revolve through, and you have to reapply for them again because you're in a trap. They do this for a reason. They want this to revolve, okay? They didn't realize you're going to hit rates like this, but they want to keep reloading all that interest on the front end. And that's what they do, and they redo these loans every 7 years or whatever it is you've got yourself locked into. If you're in a 30-year loan cycle in a house and they put you on a 7-year predatory balloon arm, whatever they want to call this today, and they then recycle you 4 to 5 times before you can actually get that loan paid off, guess what? They're eating your principal up and they're giving that all into interest, which goes directly to the bank, and you aren't seeing any benefit from that. So you need to not work with these banks in the 7-year predatory loans, which are basically all the regional banks, which means they would collapse because they have no way to make any money. So we're going to see some massive collapses happening in the banks because people are going to not stay in them, and they're going to hemorrhage, or they're just going to sell their properties. They're going to hand their keys in, and they're just, it's their cars, everything, commercial, homes, everything. Banks are going to absorb all this stuff, and there's no way to maintain it. So it's just going to dilapidate down like it always does, and we're going to see disintegration happen. And lastly, I just want to touch on this. They are going to raise probably because they cannot fight the 2-year bond. And you're hearing all kinds of people, not all of them, but a lot of them coming out saying we're going to need more rate hikes. We're going to need more rate hikes. Inflation is tight. It's not going away. Look, higher for longer or staying in one position will cause massive destruction. And there will be a point in time where if you do see the rate fall, it will fall to zero because they lost control of this, and they'll try to restart the economy by doing that, but it'll be too late and it will destroy itself because they can't control it. And even at zero rate, nobody's going to care because they're already so distressed they won't be able to do anything about it. And so this system will just come crashing down. But yeah, look at all these guys. Oh yeah, we're going to raise. I got one or two out here saying, but we're going to keep rates at this level for a long, long time, man. Cuts may not happen in 24. You're going to hear this one. If you hear it at all, we'll see what happens in the 6 seal event in January. I'm just saying. This is bad. Guys, get ready. Things are going to get ready to break. The markets are getting ready to tank. Let's go check the Dow real quick. This fluctuates a lot throughout the day. We're down 432.21 points right now. I don't know where it's going to end up. Could be higher, could be lower. Bonds are still melting up. That's going to dictate everything out here. So keep an eye on all this stuff. I'm trying to show you these indicators so you know what to look at when you go out there. And oh wow, we just crossed the 33,000 zone again. Oh, it's not going to stay there, folks. I'm telling you, this one's getting ready to come down hard. And especially as you walk into the 3rd and 4th quarter. And you always need to understand that even though the job numbers or whatever they give you come out fairly strong or in their favor, you have to go forward a month, because when they revise these numbers, they always revise them significantly down. So you never really get a true handle on what's happening at that very moment in time. And so you need to realize that this all plays out. And usually, you've had, I don't know how many raises. You've gone from basically 0 to 5.5 in a matter of a year and a half, and it takes about 6 to 18 months for these rate hikes to actually move through. And so you're not even seeing the effect of all these rate hikes before they might raise again, which would cause even more structural damage out here. They're going to have to reset this. Janet Yellen just printed 1.5 trillion in treasuries to maintain the government until McCarthy caved and gave the Democrats everything, which allowed them to keep the government open for a whole 45 days so we can do this all over again. And the question is, what are you going to give up next time, McCarthy? Oh, that's right. They might remove you because you're not being a good player. So anyway, we'll see if that happens. McCarthy, if you lose your job, it's because you deserve to lose your job. And I'm not getting political. He just doesn't get it out here. He's an established institution like all the rest of them out here, and they all play together regardless of what symbol they hold on their side their name. Okay, God bless everybody. You gotta watch this one. This one is getting ugly. It's gonna get real ugly. I keep telling you, into the 3rd seal. We're moving into destruction phase of God getting ready to walk into Israel, Israel through Syria. Watch for that invasion, man. I'm telling you, the Kurds are getting hammered right now, and Erdogan's planning on getting either weapons or leaving the EU and invading Syria, which is going to start a Daniel 8 moving into a Ezekiel 38:39 prophecy, possibly as I show you on my charts before the end of this year. God bless. Have a great day. Find Jesus. Find that open door. You have very little time. Things are going to break and you're not ready. I can tell you right now, you're just not ready. You need to get ready though. God bless.